I'm Marella Fernandez. Thanks for joining us on Market Call today. Hap Sneddon is on the show, President and Chief Portfolio Manager at Castlemoore. He's going to take your question today on technical analysis. Call us toll free, 1-855-326-6266. You can also email questions to BNN Bloomberg. .ca, market call at bnnbloomberg.ca. Hap, thanks for coming in today.
Thanks for having me, as always.
Since the markets are doing a bit of crashing today, we're going to take a quick look and see where we are at the hour, the effects of the tariffs and counter tariffs as announced by Washington and most recently China. So the TSX down today 987 points or 4%. It was down even more earlier this morning. The S&P 500 taking a 200-point plus hit, also down more than 4%. The NASDAQ down 682, also losing about 4%. And, of course, that is on top of the losses yesterday. So let me ask you first what you think about the tariffs as they were rolled out, sort of how they were applied in a fixed rate to each nation. What are your thoughts on the way this was rolled out by Washington?
Oh, the rollout was crappy. Once you dig into what the point is, I sort of looked at, it made me look at, okay, the U.S. administration rolled out all these tariffs, and they talked about sort of fair treatment. So I went around and looked at the existing tariffs on U.S. goods into other nations, and they're astronomical. So I sort of get, and they were, if we look at Vietnam, they got hit with 45%. Well, they have a 90% tariff on U.S. goods. So when you look at what the end game is, which I believe is going to be everyone coming with free trade or some version of that, the end game is kind of noble. How it was rolled out was, in my view, terrible. Maybe history will look at this and say this is how it had to be done because, it's been sort of piecemeal for maybe 30, 40, 50 years, right? You go to Europe, you don't see U.S. cars. And they've always claimed some sort of a cultural thing, or any nation can do that. With the exception of food security, I think that, and that being a nation gets to make sure that its food supplies are safe. Everything else is probably open, and that's where we're going to get to eventually on free trade. You
said you understood the logic of having higher tariffs on other nations for the U.S., I guess, but the way it was rolled out was not done sort of the best that it could have been. How do you see that differently? What would have been a better way to introduce this if the goal was, as you say, to even out the tariff situation?
Well, it might have been to have dialogue with each country. That might have taken 10 years. You never know if you kind of, I think that approach seems sensible, but, that's why I alluded to the idea that if we go ahead, 5 years history might look back and say this was sort of necessary to usher in another wave of growth. I mean, as I said, the rollout's been awful. Sentiment right now is out of 100, there's a couple gauges out there, 100 being exuberance and 0 being that is it. We're at 4.
Oof.
So, there's the old adage, when things speed up like this, investors should slow down. This doesn't feel like it's going to break quickly. But the worst of the news, the sort of the cascading of the news, China today pushes where it's at. I went and looked at China's tariffs. They're very large on the U.S. When China talks about going to the WTO, and that kind of rings a little hollow that if you want to address this, I think every country has to start to negotiate. But the rollout, probably couldn't have been, I don't know how it gets rolled out. Does a 10-year slow walk work better than sort of shock and awe, and then we kind of get somewhere quicker than just maybe a malaise for a much longer period? That part we still don't know. But as I said, when we look at the sentiment, we're exceptionally washed out. If you're a short-term trader and you wanted to short, you're too late. Both short-term, long-term, medium-term, you're probably better off looking at where there's value right now than trying to protect anything.
Got it. Okay, we're going to take a quick break to line up your phone calls for Hap Sneddon, President and Chief Portfolio Manager, Castlemoore. Again, taking your questions on technical analysis. Back in a moment. Welcome back, and thanks for joining us. We want to get straight to your questions for Hap today. So Bev had a question that she's emailed in. She says, please provide your technical analysis on white cap Resources. Hap, can we take a look at Whitecap?
Yeah, if we look at this on the chart there, what we will see is it broke below this March low. That is usually an indication that we're actually going to go up some level lower. Pardon me. If you look back here, you can see something that happened right there back in from a December low. It happened in late February, and then we usher in a new set of lows. It did it again. So we would have to go back. I'm not sure if the control can go to a 3-year, but we'll sort of try to find out, okay, where are we going to find support? And I imagine a lot of the charts that we look at today, we're going to see that. So we broke that. Okay, so this is a bit of a longer term move right there. We probably have to go back even further, and that's a quite a long 3-year wait to lose that much money over that time frame. So right now, it looks like Whitecap, subject to a sort of a dramatic reversal in the price of natural gas, which Whitecap is, I believe, more disposed to, and crude, that it's probably going to keep probing a bit lower here. There's no place to hang your hat, as you can say.
Okay, so if you were going to sort of dip in, we don't know whether she's in it already or not. You might even wait for a further dip.
I would wait. Yes, I would wait clearly on this one. All the energy is going to be a bit of a wait and see. That's had a lot of damage done to it in the last 2 days. Today's a big one, but you want to kind of wait. As I said earlier, there will be value there, but you just got to find a place to where to step into.
Got it. Okay, let's go to the phones. John is on the line from London, Ontario. Hi, John.
Hi, Marilla. Thanks, Hap. I appreciate your dissertation on macroeconomic effects on stocks. I think Mr. Trump is probably trying to devalue his currency the way China did during COVID, thereby decreasing their national debt. In any case, when you have such a conflagration of macroeconomic disaster, are there any technical features that you look at to try to, I mean, we can't predict precisely the bottom, but anything that tells you that things are about to turn around? Thanks very much.
Interesting. So a wider picture.
Yeah, great question, John. I think the way I address this, and this is something that we look at Castlemoore whenever we get these situations, what are the things that start to pop up to catch our attention, to say we're getting close to a bottom. It doesn't mean we're going to resume some uptrend. There is some speculation that this is going to be some type of a V, because the macro picture is still decent. Will this break that? That's what everyone's trying to find out. But to answer John's question, the first thing I would look at would be, sentiment. Where are we at? I gave you one off the top. It's a common sentiment out there. John, you can go find it. It's called Fear and Greed, made up of 7 components of different varying bond yields and all these different components. And right now we're at a 4. Last I checked, just before we came on, we're at 4. That's out of 100. Mm-hmm. So, you can't go below 0. So we're really getting there. So what does that do? That kind of gives you the background. Other things you can look at, and we didn't get a chance off the top, but look at the put-call ratio. Put-call looks at how are people buying insurance through options. And usually the higher level of that occurring is indicative of the opposite happening. So the more people go out and buy insurance, the more it's going to be sort of...
The less confident they are about putting money in the market.
Yeah, so the time you buy insurance is when things are quite high, right? Not when things are low, because your insurance cost is too high. And then you can just look at that, once you see something starting to go sideways a bit, not make a new low. And that we saw that, John, with Whitecap. So if you're looking out there for ideas to buy, what's acted well today, even if it might be down 3 or 4%, one of my top picks will be one of those names. A couple of them are ones that have acted quite well through the salt. They're still suffered a bit, but that's where you can see strength on the other side. So sometimes you're not going to get it perfectly, but you have to start to look what the strong names are if you've got cash or you want to make some top grading to your portfolio.
Got it. Okay, let's go back to the phone lines. Elliot is on the line calling from Hamilton, Ontario. Elliot, what's your question today?
Good afternoon. Against the backdrop of continuing tariff turmoil, I think we're probably in for 2 more significant hits in about 8 weeks, with the debt limit, what might be a debacle to repeat 2011, and of course Trump versus his deficit hawks when he tries to push his taxes through at the end of the year. Against that backdrop, what are the 2 next significant support levels for Alphabet? Not just down 1 or 2%, but maybe down 5, 6, 10%. Support levels, please. Okay,
thanks for your call, Elliot. We'll have a look at Alphabet, which is at 149 today.
Yeah, and that's great. I love that the producers went right to the 3-year chart, because sometimes you can't see something in the short term. So the thing that we would have looked at maybe a little while ago, back in maybe it looks like mid-February, was this break here right around, looks like 160. The next spot we're going to probably find some support is really close to where we're at right now, and that would be around the 140 level. Shy of that, we're probably looking at a band right there around 110 to, let's call it, sort of 80-ish. And sort of, you would, anything in this area would probably be acceptable if this upper level right here at 140 breaks. So 140, then you're probably looking at sort of a chop between sort of, let's call it 90 and 105. So two places that you could kind of, if you don't own it and you wanted to buy it, and I talk about this all the time when I'm on, is one way to deal with markets, investing, is through portfolio management techniques. That has nothing to do with your fundamental analysis, your technical analysis. It's simply putting money in over a period of time, taking out some of the finite guesswork. If you want to own Alphabet and it's been washed out here by 30%, well, go buy, and you want to own a 2 or 3% position, go buy half it right now today, and then watch for that second half before you do that.
So dip in over a period of time.
Over a period of time, and that takes away you trying to guess any particular market being spot on. So.
Got it. Okay. It's good. It's good advice, especially in times when it's unclear what's immediately ahead. Let's get one more caller in. Dominic is calling from Montreal. Hi, Dominic.
Good morning. Good afternoon. Thanks for taking my call. I'm intending to dollar cost average on my shares of Nvidia. I'm a believer that the insanity of governing with tariffs will soon give way to negotiation. Earlier this morning, the VIX hit in the 40s. I wonder two things. Do you use VIX as an indication, to getting in on a position? And what do you see as an entry point for Nvidia?
Can you explain VIX a little bit so people understand a little bit more about it and when you use it, if you do?
Yeah, well, that just to make it simple, it's another version of an indicator that sort of tells us about the nervousness. So we talked about fear and greed. That was just sort of a simple way. VIX is a component, I believe, of that. There we go. We got a graph of the VIX. That is, and we're right back to a high here. So if I own the VIX and we have owned it in the past, this is probably a really good time to sell. We're ready to peak that we saw back in August. Look at same spot right here. And this is somewhat misleading because you had to hold this through that whole year and be down significantly at times and then to get up to that 171%. But I certainly would, if I was holding VIX as a insurance in my portfolio, I would sell it. So it's volatility. It's volatility, and you can short the VIX, you can be long the VIX, you can be 2 times the VIX. It's not a position that you hold because it's got decay to it, meaning there's contracts in there that expire and they keep rolling them over. But on the VIX level, to answer Dominic's question, yes, we do look at it. But again, it's a background thing. It's not perfect at timing. It tells you, the neighborhood you're in, but it doesn't tell you, what to do. It just sort of tells you that maybe you should be doing contra moves to the VIX spiking. So to go short when it's at this level, you would have to expect that we're going to substantially go higher. And I'm not sure. We'll take some time when we close today, but you can look at these moves in terms of standard deviations. How many standard deviations, sort of complicated math, away from the average are we? And when you get moves of 2 and 3, those numbers don't sound big, but they're quite big in terms of the standard deviation away from the average. So, so back to Nvidia here. A break right there. Nvidia is going to be hard, I think, because it's it's very widely held. It's going to be subject to a lot of volatility. But that level there, this line right here, probably
Where
around.
would you say that is? Yeah.
Yeah, I guess it would probably look somewhere around $90, $95. That it would look at, and why here? Because we had some action here, and then we saw that little breakout there. And so this is where you had this area here is where you had a whole bunch of new dollars come in, and so that's the logical place where you might find that support again. Nvidia apparently is quite. Positive on its situation. We saw there was a couple of announcements recently about some analysis of its chip use, and it's not gonna slow down. But when you have this kind of market, they throw the baby out with the bathwater. So, you can pick up really good long-term companies, I alluded to earlier, but by just being patient and deciding, you know what, I don't own Nvidia, I wanted to own it, I'm going to buy half my position here and just sit tight and see what happens.
Got it. Okay, we're going to take a break. Back with Hap Sneddon, President and Chief Portfolio Manager, Castlemoore. He's taking your questions on technical analysis today. Back in a moment.
Making sense of business and the economy can be tough. We dig through the details to tell you what you need to know with straight talk and expert analysis so you can make informed decisions about your future.
Taking Stock, Fridays on BNN Bloomberg.
Thanks for joining us. Let's get straight back to your phone calls for Hap Sneddon, who is here to take your questions on technical analysis. Joseph is on the line from Montreal with his question. Hi, Joseph.
Hi, thanks for taking my call. I want to hear what you have to say, Hap, about the prevailing rate environment and how that affects your technical analyses through the lens of real estate investment trusts, specifically Crombie REIT. I would have thought that as rates go lower and lower and lower, especially here in Canada, the REITs would do pretty well. They're not well as I thought. Crombie, however, seems to be outpacing the bunch. And technically speaking, it looks pretty good. I showed up one of my screeners the other day, RSI. Nothing controversial. It's in the 50s. MACD pointing out money flow is modest. I was trying to get your opinion on interest rates and how they affect your analyses and Crombie REIT. Thanks in advance.
Thank you. So REITs in general, what's your perspective sort of during this time?
They've actually acted quite well. We started to pick up some of the REITs. One of my favorite smaller ones in Canada was Minto. We also own the U.S. broad REIT ETF in the U.S. Okay. So the sector's actually acted quite well. Certainly, as Joseph's talked about, the rates have helped. When you get rates coming down, it makes the housing complex more affordable. When you have this volatility, there's a lot of predictability there that's not in other areas. It tends to be a safer area. Sometimes it's not because of pricing and whatnot. But in this condition, it's acting quite well. There's the income that you get from that, so that sort of tends to buffet against some of these other issues. Real estate also tends to be local, so it doesn't tend to get as impacted, although we know what we're seeing in the markets is because we believe it's going to impact everyone's, come to everyone's shores. But there's certain parts of the market where if they've got much more of a domestic look, that they can be a little bit more insulated from what's happening externally or at the stock market level. So, Crombie looks quite good, like Minto, and probably a good place to step in here. On Crombie, we've got this level right here. Sort of 1350 levels had a lot of touches and a lot of support here, a breakout here, and a touch there. So it probably wants to sort of migrate to there at the worst case. If you didn't own this would be, again, one that maybe you step into now a little bit, see if it comes back to that level. And if it doesn't and starts to accelerate, well, then pay more for something. It's always acceptable to pay more. Got it.
Okay, let's go back to the phone line. Nazar's on the line from Scarborough, Ontario. Hi, Nazar.
Oh, hi, Marilla. Hi, Hap. May I have your technical analysis on Bank of Montreal, please? The stock was trading at $140 before the tariff announcement, and it's trading around 127, 128 now. Does your technical analysis get impacted by this two-day dramatic sell-off in the markets? I read a line saying that Fed chair says it's good time to step back and let things settle down. Thanks for taking my call.
All right, let's take a look at Bank of Montreal. We'll pull up a chart in a moment. There we go. That's a 3-year. So it's down to 127.30.
Yeah, this level that it's actually come to right about here. I'm looking. I've got some stuff on my screen that we can't see on what the viewers see. But this is actually the 200-week moving average. There's another average there. The 50-week that have converged right at the same spot here. So this is finding support right here, right now. If it doesn't, it would come into this congestion sort of between 130 and 104, and that's what the top of this is, and then that's what this band is right here. So if it doesn't sort of hold close to this upper end here we're looking at, then it's going to probably come into this congestion zone and certainly be a buy anywhere between now and 104. Some of the indicators have soften immensely, but the price is sort of holding in. So when you look at indicators, they can soften. The price doesn't have to fall. It can just sort of go sideways as the indicators sort of work off this oversold situation. So that's what we're going to see with BMO, and we see that with lots of the banks. The U.S. banks, they've been harder hit. Probably going to see the same thing coming into these longer-term 2- and 3-year levels of interest.
Got it. Okay, let's go back to the phone lines. Deborah's on the line from Okanagan Falls in BC. Hi, Deborah.
Oh, hi. Good morning, everybody. My question today is on Citigroup. I was very interested in this stock in the $65 to $69 range, but I was holding off knowing the tariffs would put the red candles on the screen. So my question to you is, how would you play this one based on the technicals with such a deep decline on the charts? And my secondary question is, and this is a more global question, you look at seasonal patterns, but do you look at policy change patterns historically when you're doing your analysis?
All right, thanks for the question. Both very good questions. So let's first take a look at Citigroup, and then we'll talk about policy in a moment.
Sure. Yeah, so Citigroup, Deborah, looks a lot like BMO. As I said, it's come right back to this support where we've got a convergence on a couple timeframes. So we've got one on a monthly basis. We've got one on a weekly basis. The short term is a bit more washed out. So when you get this convergence of different timeframes, so you look at a short time frame, a longer time frame, and the longest time frame, and they start to show us a level that's relevant to each of those time frames, then you get sort of more of a robustness to that analysis because there's multiple time frames. And what we're seeing here is right around this $56. I'd drawn a line on my own chart, and it was some time ago. It was about 5 years ago, actually, of this level being quite supportive. Now, I leave this on my software, so I'll go back to see a line that I've drawn and see, it's got the data. When did I do that? And it was right at this level. So it's been a pretty critical level there. We see on the short term, some of the indicators are actually trying to turn up. Look at the crack.
There's a 5 year.
Yeah, there we go. So this 5 year, can't see it a lot from here, but it would probably be similar to that level right there, that breakout that we saw back in end of 2020. But as I was saying is that it's come right into this zone for a chart that a line that I've drawn a long time ago. So it's a really critical level where it came into. So Deborah, I would go buy half of what you want, your end result in your end holding in Citigroup. Buy it today and then see, there is a chance. I've also got another support line I drew just north of $50. So that would sort of be around this level here. Probably has to do with these tops here. I'm not sure why I drew 50.
So buy a little, wait to see if that drop continues.
Yeah, and then buy the other half.
And then buy the other half.
And then on policy, that is so hard to handicap. Sometimes policy, there's two types of policy. There's fiscal policy and monetary policy. Monetary policy is much faster. Fiscal policy usually is much slower. Now, this is a fiscal policy hit that it has come to bear much quicker. But normally, fiscal policy takes a while to sort of get there. And this is why fundamentals is what fiscal policy is about, trying to understand it. You do your analysis. People have different views. That's why when you back up and go to the technicals, you're sort of getting an unbiased view of what all investors sort of think of this. And you may have a read of some type of fiscal policy announcement that you don't think the market quite understands. And why don't they, what is the market? And you're sort of fighting that notion. And what are you fighting? You're fighting a price trend that's going up or down or against you. And so what the technicals do is stop us from trying to force our view onto things of, in this case, how is this going to work out in the trade? I've said I think the end game is going to be positive if we get there. We don't break a lot of stuff along the way. But we're going to look to see whether, how that's being processed, not by people's reaction or the business media to stories, but the market and money being put up. And that will be through an analysis of price, saying, look, people are now starting to buy.
Yeah, fiscal policy usually also, the deadlines are well in advance, right?
So your time frame is
by 2 days, we're going to do this, which is kind of the way this is rolling out.
Exactly.
Okay, we're going to take a quick break. When we come back, we'll have a look at Hap's past picks. Stay tuned. I'm now to take a look at past picks from Hap. This was May 29th of 2024. And at the time, you picked Schneider Electric SE, SB, GSY. And at the time you picked it, it was 49.06. And today it's hovering around 41. Last I looked, it was 41.07. So a return of 16% down, 16% down total return. It's also hard to look at it over the past couple of days and see what has happened sort of as the add-on after the tariffs. But what did you initially like about Schneider Electric?
Well, what Schneider Electric does, and you can see their chart, they're coming right back to some support. What they do is they are involved in the digitization, I guess you could say, of taking electricity and using it much more efficiently, using it for high value, high consumption needs, AI, transforming lots of aspects of infrastructure to be better powered. Okay. We see their trucks here in North America. You can see Schneider Electric. They do, they're at the commercial level. I don't know if they do any residential at all, but at the commercial level. So these guys are a part of a growth, longer term sort of growth infrastructure grow out. Well-run company, fairly stable as far as the kind of investment you're buying.
Would you hang on to them at this point?
Now, this one, we actually just sold it yesterday, not because we wanted to, but we wanted to sort of top grade. We wanted to actually take the money, it wasn't a big position for us, and add it to something else that we really liked during this market downturn. And so that's what we did. If we had the extra cash, we probably would have kept it. I would look back to buying it again. I think it's a great stock long term. Sometimes when you run a portfolio, you have to sort of make tough choices. You don't want to sell something, but it's just a matter of a better opportunity somewhere else.
Got it. Okay, let's get to your second pick from May of 2024. At that time, it was Costco, which was trading at 806.52 American. Now it's up to 953.71. So a return of 18%, total return with yield at 19%. Costco, of course, very well-known name, but what have they been doing right over the last year?
She's known, anytime Costco opens up a store, it's successful. They don't close stores. I don't know if they've ever closed any. I've never heard it in Canada. They've got a model they can just replicate in different countries. It's been easily transferable. Their pricing power. They know so much about their customers and how they treat them. They sort of get this exceptional loyalty, this premium loyalty. There's another name out there that you can look at today that's in this space, BJ Wholesale, really similar to Costco, but downstream a bit more bare bones than Costco even. But this whole space is actually looking quite good. If you didn't own Costco, this would be a name right now that would probably do quite well over the next year.
Let me ask you, because tariffs are in place, and I'm not sure how much product they get from where. Will they be affected? I mean, people want to go to Costco when they have less money to spend. Yeah. But how will Costco be affected by tariffs?
That's a good question. Their produce probably a little bit less impacted because it's going to be sourced more locally or regionally from where they are. But some of the more hardware goods, which I don't know what percentage that is, the coffee makers and all the sort of the consumer goods that are in the internal part of the store, the center section, may be impacted from a pricing perspective.
Got it. Okay, let's get to your third pick then. It's Chemtrade Logistics. At the time was $9.16. It's dropped to $9.11, so 1% drop return, but a 6% upside total return. Tell me a little bit about Chemtrade.
Chemtrade, they supply chemicals. One of the biggest areas they supply chemicals to is in the water treatment. So they're probably somewhat isolated because Canada did skate pretty good. When we look at the bottom line, for us, it was about a 5% net increase. And we, if you take out energy, we actually have, the last read, we had a surplus with the U.S. So the energy has a big component of whether, what the balance of trade is between the two countries. But this is one that will probably do reasonably well because they're the chemicals they supply to water treatments all over North America are sort of much more niche-y. They're a low-cost provider. They pay a very nice dividend. It's a well-run company. So I would imagine they're going to do much better than the sort of the average industrial company because they're very deep down into the use of its products.
The drag down you see at the start of the year is just sort of the general drag down with everything else?
Well, when we have this volatility, people are going to go upstream a little bit more for sort of high quality names. But when you look at, so we're talking about there, but when you look at where it came out, this sort of $9 range was sort of an expected place that it would sort of come to because it has a reasonably decent dividend. It tends to get a little bit more, once you get into a place, people will sort of bear it out a little bit more. What we saw in the real estate units in the Crosby and what we'd see in Crombie and we'd see in anything else. When you have a decent dividend, it's fairly safe. You're going to get a little bit more support from the market than if you don't pay a dividend.
Got it. Okay, we're going to take your questions when we come back. Hap Sneddon is here with his technical analysis. We're back in a moment. Welcome back to Market Call. Thanks for joining us today. Kevin's on the line in Ottawa. He has a question today for Hap. Hi, Kevin.
Hi, Hap. Thank you for taking my call. My question's on Honda Motors. I've been watching this for a while, and you look at its long-term chart, 5, 10 years. It's always been very flat, and I know it pays about a 5% dividend. But I'm just thinking, they make such good cars. And I'm just wondering if you think now would be a good time to get in. I've been waiting a few years, but the stock hasn't moved that much. So its graph over the last 4, 5, 6 years just looks horrible. And I'm just wondering, do you think this might pick up considerably after the tariffs are done? Thank you.
Okay, so tariffs, are they going to be greatly affected by tariffs? I'm sure they do production in the U.S., but Japan's been tariffed. All of Asia's pretty much been tariffed. I'm just wondering.
Yeah, to me, the hardest sector, the hardest area to try to figure out is autos because of the part sharing.
The integration of the system.
The integrations, them having manufacturing facilities in the U.S. and different, so that one's a really hard one to look at. If we're able to pull it a little bit further on this chart, if we can do a 10-year chart, we'll see a little bit better of what, what the caller was.
There we go.
There we go. So this is sort of what he's talking about. It's been kind of gone nowhere for quite a long time. It's sort of, it had a decent run from about 1984 up until about 2008. And then actually, it made a high in 2011. So just before, the back here on this side of the graph, there's a high. And then since that high, it's just gone entirely sideways the whole time. So it's sort of been dead money. But having said that, the low here of around $22 would be that low, would be, again, I've said this a couple of times. I would go out and buy, if he's interested in owning it, I would go out and buy half your position right now.
So he already owns it, and I think he doesn't know what to do about it because, as you say,
I certainly wouldn't sell this.
Okay.
We did have a high just early last year of around $40. Now we're cut by 30-40% in the span of a year. You're getting that dividend, and he's been through this before. This is not the first ride. We've seen these rides before. So if you've had Honda, this is sort of nothing new to you.
But hang on for the.
I would certainly hang on to at this point. Yes.
Okay. So we do have to take another break. We're going to be back with Hap in a moment. Stay tuned. Welcome back to Market Call. Let's go right to the phone line. Solomon's on the line from Edmonton, and he has a question today for Hap. Hi, Solomon.
Hey, how's it going? So I just had a quick question regarding Amazon. I recently opened a position just because, of course, it's down almost like 25% or 25% from when it was up at around $240. And I have some buys set in the 140 and 160 range. I was just wondering, where do you sort of see Amazon going, and if you think those two buy points around the 160s, 140s are reasonable?
Okay, thanks for the question. Let's take a look at the chart. Amazon down like a lot of the technicals. It hasn't been hit as much, I think, by
No,
this.
it's actually acting pretty well today. It's actually, when I look at my screening, it's actually screening very, very well. Now, from this chart, we're not going to be able to, pardon me, we're not going to be able to tell a heck of a lot. We actually have to go out a bit further, and I'm going to do that on my chart here that I'm looking at, and we'll see that we've got support right around the 175 range. And then we'd have some really big, heavy support around 155. And then after that, we have a level at around 120. So right now, we've got some support. We've got some support around 155. And then again, as I said, around 110, let's say.
Okay.
But the way it's acting today, we're trying to get some of these indicators, and we can't see them, but these are sort of sine wave things that look like that I'm looking at on my screen. And, a stock just moves up and down. This would be strong, and this would be weak right here. And we're seeing some of these indicators, not the price, but because that's not too bad for the day, but these indicators trying to turn up, which means that some of the selling has been sort of maxed out. You're getting people starting to step in to buy Amazon.
Okay, so that's a good sign. He was saying he does think it might go down a little bit lower. You agree?
155 and then around 110.
Got it. Okay, let's go back to the phone lines. Then we have Mike on the line from St. John. Mike, what is your question?
Hi, good afternoon. Hap, I'm just looking for your technical analysis on Hammond Power Solutions. It's come off quite a bit from its all-time high there. I just wonder what your analysis says. Thank you. Have a great afternoon. Bye for now.
Have a good day. Okay, Hammond.
Yeah, Hammond. We saw a peak there, it looks like, in the all-time high, and we did see a double top. So that was a bit of a warning sign. So we saw back about a year ago there in April, right about, a couple weeks from now, a year. And that was, so there's that double top we're talking about. Actually, you could find a triple top if you go back up there a little bit. And usually when you have these scenarios, these tops that it can't get through, eventually the negativity, wins the day, and the negative soldiers vanquish the positives, and that's what we saw there. We also saw this trend line right here break pretty dramatically there around 120. Right now, pardon me, we're just above some longer-term support. So I've gone out to a longer-term look that looks back multiple years, and it looks like the best place right now that we're going to find support is around $60. So that's not terrible. So around $60. So a bit lower than another 13 on 73. So maybe another 8, 9, 10% kind of thing. A little bit higher before it would get support. Now, when you sort of move downstream, we just saw Amazon, and now we're talking about a much smaller company. People will dip their toes in usually, unless there's something very specific to the smaller company that the market is just entirely discounting. Some great news and it doesn't care. But the market, investors step into the bigger names first. And so you will probably see names like this languish for a little bit. And I go it a little bit further, and that level that I gave you, that sort of $60, becomes even more apparent, is that is the place that you'd find buyers come back to. Doesn't mean it has to get there, but that is the place that, we're sort of in no man's land right now. Where could you hang your hat if you didn't own it? Or put on a level to sell if you do own a lot of this and you bought it much earlier, then that would be the place to look at.
Okay, let's squeeze in one more phone call. Linda's on the line from Angus, Ontario. Hi, Linda. What's your question?
Good afternoon, Hap. If I could please have your analysis on Suncor, and let me know if you think this is a good entry point. Thank you. Have a good afternoon, all. Take care. Bye-bye.
Well, this is another chart. I love when I come on and I pull up my system again. People can't see it because I've got sort of a history in every stock. I might do notes and they stay there and they tell me when did I make these notes and all that. And so one of the lines I had on here was at $47.
Okay.
And these are not scripted. I just, I take lots of calls because we can do that. But this line that I drew this line back in 2009.
Oh, wow. Okay.
So we're talking about some pretty deep support. Now, Suncor, We've kind of gone nowhere there for a while, and this break is significant. But you can see it came right up to this level here in the past couple of years where it kept having trouble getting through. It finally did. It goes to a new level, and then it comes back. It'll kind of migrate back to that level where we had previous support. If we can go back a bit further, we'd see that.
Okay, we'll pull up the 5 here.
Look at that.
I
What
guess.
a crack
So
team.
48 there, and moving on. Here we go.
There we go.
Okay.
Yeah, so this whole congestion zone here is kind of what we're talking about. This would be an area of interest, and particularly the top part of it. This one might be a bit of an anomalous. I think we're already below that level, but sort of the top part of that range, and that's sort of the bottom of that zone that we see right now. So that would be the first place. If you didn't own Suncor, certainly it's been on sale the last 2 days. Energy has been hit dramatically. I'm not sure what the backstory is there. Maybe over the weekend I'll sort of have a chance to sort of figure out why is energy being so strongly hit. I know OPEC Plus is still cranking it out, but I don't know if the market is taken that and run with it. We talked about it earlier, baby in the bathwater. They're selling cats and dogs. Right?
Yeah. Well, they've hiked their production, right? So they're going to roll it out faster. So that's kind of playing in as well.
And then we did have the drill baby drill sort of.
Yes.
Yeah, that sort of is not a. The companies aren't probably rushing to go out and finance the project.
Right now anyway.
Yeah.
Okay. Hap, we do have to leave that part of the conversation and the phone calls there. When we come back, we will share his top picks. That's coming up next. Welcome back. Time now for top picks with Hap. Definity Financial is the first one we're going to look at. Why do you like Definity Financial on the TSX?
It's a very predictable company. We've held this for a while. We keep buying it. We start keeping this around $30. They're a smaller, probably I think the 6th or 7th largest property and casualty insurer. They do auto, property, liability coverage. They do businesses and individuals. There we go. Pretty stable chart there. The bottom line start with these guys is their return on equity has got an exceptionally bright future. The way they run their business, recent earnings prove that. They saw the top line growth over 9% and really good expense management, which is key in insurance business, right? That kind of make sure you're keeping your expenses under control because they operate on sort of very finite margins of what they do. The underwriting investment income, the gross premiums, that's a big deal in insurance. They also showed really well, and it's got an excellent management. Pays a decent dividend, not as good as it used to be, but just a well-run company. I'm not as experienced in the insurance business is a little when you get up to the regulatory, but to me they would be a candidate to be bought. But I know that's a little more complicated when you deal with insurance companies. But fantastically well-run company here in Southern Ontario.
Okay, let's get to your next pick, which is a well-known name, Berkshire Hathaway, of course. Today, just looked it up, trading around 501. So it is down like everything else, but you still like it moving forward.
Yeah, when you look at how it's actually acted, this was the name we added to yesterday that we sold a bit of we sold Schneider for, just because of how this is acting. You can see that it's still a pretty, quite a reasonable chart there. We've got support back here around the $500 level. There always is concerns that Buffett isn't getting any younger. He's 94 years old. But we know that there's a longer-term chart there, and this has beat the S&P on all time frames. They've got a massive cash hoard, so when you're looking to try to figure out where to deploy money in this market, why not get a little help from some other people that can do it? $478 billion. They will find something that they'll use that cash for, and as I said earlier, the legacy on them is the legacy planning they have is one day Warren will not be here, but the company will live on, and I think that's what he expects, and Munger. That's everything.
But the people who are going to run it after him believe in his fundamentals and are going to sort of move forward under that guidance?
100%.
Got it. Okay.
Yeah.
Let's go to your third pick then for today. The third pick is Coca-Cola, which was a surprising one. Why do you like Coca-Cola?
Well, Coke, when you look at what they do, they've got the basic Coke, but the brand strength they have. I mean, we can go through the names. There's tons of them: Sprite, Fanta, Dasani, Vitamin Water, Body Armor, Powerade, and on. Is in the teas. They've got a big potential expansion in coffee. So that's another area that they're going to be, getting into.
We're going to see Coca-Cola coffee.
No, just the coffee category.
Okay.
Not
under that brand.
Yeah, adding coffee.
Might not be a bad thing.
No, I don't. And due to its focus on the total beverage portfolio, as I said, the new developments in coffee, their pricing power, their geographical diversification, they're really close to all their retailers, and they really get local culture. So what Coke can do in Southeast Asia, what it can do in Northern Europe, what it can do in South America, it ports its brand. It takes its brand to those places and operates quite well. And then on a technical basis, you can see here, we got a little bit of resistance. We want to see it kind of plug through that, but the chart for Coke is pretty decent, pays a decent dividend, and it's been down much less than the market last few days. And that's where you tend to look for strength coming out of markets. You don't want to get super heavy into super defensive, which Coke kind of would be called defensive. At this time of the market.
A defensive stock?
A little bit defensive. Beverage tends to be a defensive. It's very predictable. People will still buy their drinks as opposed to, maybe they won't buy a car, but they'll go out and buy some drinks. So it tends to operate in a defensive basis. But technically, and all the earnings and all the components right now look really good. The market backdrop doesn't impact them as much as it would other companies.
Got it. Okay, good to know, because I didn't realize it acted that way. And moving forward, if there is a recession, people are, again, trying to figure out where to stash their money to be safe. Hap, we got to leave it there. Thank you for coming in. Appreciate your time on this. We do want to take a quick look at the markets as we head to a break, just because it is that kind of day. So the TSX is now down over 1,000 points, 1,070 or 4.4%. The S&P 500 down 253. It has lost almost 4.7%. The NASDAQ also taking a hit, down 788 points, and it has lost about 4.8%. Remember, China has introduced retaliatory tariffs on the U.S. after Washington's markup on many of the countries in Asia. So a lot going on. We're keeping an eye on it. Thanks for joining us on Market Call. We'll see you again on Monday.